Hey, good afternoon, ladies and gentlemen. Today, on our weekly market review, we are glad to welcome back Mr. Gerald Wong, who will be sharing with us what is the latest happening in the market. How are you, Gerald?
Very well. Had a good weekend. How about yourself, Sunny?
Yes, I had a good weekend too. And last week, we saw that there was a US holiday, Labor Day on Monday, 4th of September. So it was a rather short trading week on the US side. So managed to catch a breather. However, since the beginning of the month, we saw the non-farm payroll data. We saw both of the ISM data coming in, which shows a very strong resiliency in the US job market right now. What do you think? And will you be sharing more on that in your presentation today?
Yeah, so definitely a lot of economic data that is coming in.
Mhm.
And I think as we approach the end of the year, investors are starting to look forward to 2024 to see what the new year actually brings for the investors. So that is what we will actually run through a bit more of today. But before we start, as usual, with the disclaimers that whatever is discussed today is for information and education purposes only and should not be taken to be financial advice. Okay, we also have an upcoming SIAS, and this is exclusively for members only, that is coming up this week, 13th of September at 7 p.m. So if there's something that you are interested in, do consider joining SIAS as a member. Last but not least, do leave us a review on Google if you find today's session useful. Okay, so I will start by doing a quick recap about the market. And what we saw in the past week is that the US as well as the Singapore market saw a bit of a pullback. The S&P 500 was down by 1.3%. And we saw that the tech-heavy Nasdaq was down by a deeper 1.9%. Closer to home, the STI was down 0.8%, really reflecting the weakness in global market that we saw in the past week. So what is driving this pullback in the market? So earlier you mentioned some of the stronger than expected economic data that was coming out from the US. And I think this is something that we do not see in the Singapore economic growth. So while the US market has been fairly resilient, what we see in Singapore instead is that if we look at what private sector economies are expecting for Singapore's GDP growth this year, then it has actually been cut to 1% from 1.4% in the previous forecast. Okay, so in terms of the economic growth outlook for Singapore, it has actually weakened. So in terms of GDP growth, last year it was 3.6%. Now, private market economies are expecting growth to be just 1%. So I think the very strong economic data is something that is more particular to the US market. But outside of the US, actually, we see that the weakness in the global economic growth actually persists. And on top of that, what we saw in the past week is actually that Saudi Arabia and Russia agreed to extend their voluntary oil production cuts to the end of this year. And that actually led to a bounce in the oil prices. So if you look at Brent crude oil prices, they actually closed at above $90 per barrel last week. And it is actually the highest level since November last year. So if you recall, because of all the concerns about slowing economic growth, we've seen actually a pullback in oil prices for most of 2023. And that has actually led to a moderation in the inflation data as well. So if you look at the US CPI data, that has actually come off over the past few months. And a big part of it is actually driven by the weakness in oil prices for most of 2023. So the concern now here is that with oil prices starting to be back at $90 per barrel once again, we might actually see inflation starting to come back, and that might actually lead the Fed to keep interest rates high for a longer period of time. So that is something that investors are looking out very closely for. And this is something that we have always been sharing with investors in terms of what are the expectations on the interest rates over the next 12 months. So this is from the CME Fed Rate Watch tool. And effectively, what you see here is that currently the interest rates are at 5.25 to 5.5%. There is a FOMC meeting that is coming out on the 20th of September. And based on current expectations, 92% of investors are actually expecting that they will be keeping interest rates at current level. So no change. But once we come to the November one, then it becomes a bit more uncertain, because while investors are expecting that the Fed will keep interest rates at current level in November, if the economic data continues to come through very strongly, then there is a potential for interest rates to be hiked potentially another time when it comes to the November meeting. But at least for now, there is no further rate hikes expected, but we will continue to keep a close lookout for this data. In particular, we have the consumer price index data that is coming up this week, and that will give us a further sense as to whether inflation is continuing to moderate or whether we might see further inflationary pressures that will cause the Fed to have to keep interest rates higher for a longer period of time. Okay, so next we come to the Singapore market. We saw earlier that the STI saw slight losses over the past week. In terms of the top gainers, we had a few components within the STI that managed to see some slight gains. We have the DFI Retail Group up 2.8%, Thai Beverage up 2.6%, a few China exposed stocks that saw some gains, Hong Kong Land up 2.5%, Yangtze Shipbuilding up by 2.4%, and last but not least, ST Engineering up by 1%. So in terms of what we see in terms of these stocks, some of them effectively are beneficiaries of the stronger US dollar, which has become a theme in the market over the past few weeks, as we see that the US dollar continues to climb as the US economic data continue to come through very strongly. Next, we also have some companies that are beneficiaries of a weaker Chinese yuan. So Yangtze Shipbuilding, as an example, actually saw gains of 2.4%, given that its contracts are in USD, but a lot of its cost is actually in Chinese yuan. Okay. If you look at the top losers, we saw some of these STI components down in the range of 3 to 4%. So CapitaLand Investment down 3.4%, Wilmar 3.4%, a few industrial stocks, say Seatrium down 3.4%, Jardine Cycle and Carriage 3.9%, and Sembcorp Industries 4.3%. So in terms of some of these losers that we saw in the past week, some of them have actually seen very strong gains over the past 12 months already. So Seatrium and Sembcorp Industries, as an example, they have been some of the top gainers within the STI. So we are starting to see some profit taking in these names, maybe due to concerns that the economic weakness might actually be stronger than what some investors were previously expecting. So we'll dive deeper into some of these names. In particularly, we get a lot of questions around how investors can think about names that are exposed to the higher oil prices. So one name that we saw actually moving up in the past week, not an STI component stock, but a Singapore Depository Receipt, PTTEP, actually moving up due to the higher oil prices that we saw over the past week. Earlier, we saw that Sembcorp Industries was one of the top losers within the STI, but at the same time, we saw that the company has actually been doing share buybacks, and actually that has helped to be supporting the share price. And last but not least, within REITs, Digital Core REIT announcing that it is going to be included in the FTSE EPRA Real Estate Index from 15th of September, and also announcing a number of management changes. So we'll look at each of this in detail to actually see how that's actually affected the share price performance. Okay, so first and foremost, we'll start with PTT exploration and production, because of the fact that many people have been asking, with higher oil prices that we have seen, what are some of the names in the Singapore market that are exposed to higher oil prices? So while a lot of the attention has been on names like Seatrium and other oil services company, we thought it is also worth highlighting the Singapore Depository Receipt, because this is a new product on the SGX. PTTEP was listed at the end of May. And effectively, in the past week, we have seen the share price going up with the improvement in oil prices as the production cuts actually come in. So for those who are not familiar with PTT exploration and production, effectively, it is very simple. They are an oil and gas exploration and production company based in Thailand. It is also one of the largest oil and gas exploration and production companies in Southeast Asia. So in terms of the business model, very simple. If oil prices go up, it is able to get a higher average selling price. And if you were to look at the average cost of production, over the past few years, it has consistently been below $30 per barrel of energy. And the difference between what's able to sell and its unit cost will effectively be its profit. So if the oil prices continue to move higher, what we will see is that it could potentially have an average selling price that's also higher and be able to make a higher profit as a result. So that is what we see in terms of its share price performance. So if we were to look at the listing history, recall that it was listed as a Singapore Depository Receipt in late May. And with the bounce in oil prices over the past few weeks, we have started to see a very strong pickup in its share price as well, closing at 645 Sing dollars at last Friday, given that it has been seen by some investors as a potential beneficiary of the higher oil prices. Okay, so that is something that we'll keep a close lookout on as to whether the share price continues to move with the movements in oil prices over the next few weeks. Next, Sembcorp Industries, also a name that is commonly asked by investors, given that we saw very strong share price performance over the past 1 year. But then if we were to look at the past 1 month, effectively it's corrected by close to 15%. And even in the past week, it was the top loser within the STI. So the news that we see here is that the company has actually commenced a share buyback with the weakness in the share price that we have seen. And effectively over the past week, from 4th September to 8th September, the company actually bought close to 1.8 million shares at a range of $5.10 to about $5.26. Okay, so consistently for every day over the past week, it's been buying 365,000 shares per day in the range of $5.10 to $5.26. And that has, in a way, actually helped to support the share price a bit. Okay, so this is the share price chart that we see for Sembcorp Industries from a peak of about $6 in a few weeks ago. It's actually moved down, and last week closing at about $5.12, despite the share buybacks that the company has actually done. So that is something that a lot of investors are wondering, what is driving this weakness in the share price. And I believe a big part of it is driven by profit taking, given that the share price has moved up very strongly over the past 1 year. Okay, last but not least, a lot of investors are interested in REIT. So we actually see news around Digital Core REIT announcing that it will be included in the FTSE EPRA REIT index from 15th of September. So for those who are not familiar with this index, you might know what the STI is. But this is actually a REIT index that is closely tracked by a lot of institutional investors. And with the inclusion, there is a likelihood that this will be more on the radar of institutional investors in time to come. The company also announced several management changes that could help to propel the company going forward. So one of the questions that we commonly get is, what's the difference between Digital Core REIT versus Keppel DC REIT? So we have done a quick comparison here. In terms of the fundamentals, what we see is that both REITs have got fairly strong occupancy rate, and that is really driven by the continued strong demand that we see for data centers. the occupancy rate of digital core REIT remaining at about 97% as of June of this year. With the higher interest rates, a lot of investors are concerned about higher borrowing costs and whether they are able to stay within the regulatory limit for their gearing ratio. So for digital core REIT, a gearing ratio of 34.2%, so safely within the regulatory limit of 45%. If you were to look at the consensus forecast for dividend yield, currently at 6.6%, depending on what you compare this to, if you're to compare with the average of the industrial REITs, it is slightly lower than the sector average of 9.2%. But if you're to compare with Keppel DC REIT now with a dividend yield of about 4.7%, then the dividend yield based on consensus forecast offered by Digital Core REIT is slightly higher than Keppel DC REIT. So this is what we see for the share price of Digital Core REIT, moving up very strongly after the weakness that we saw over the past 1 year. With the concerns that there might be some challenges faced by its customers, we saw Digital Core REIT share price moving down. But then with the increased optimism towards the tech sector, and that if we were to look at the inclusion into the REIT index, plus some of the management changes, that has helped to boost sentiment towards the REIT once again, and helping it to be one of the best performing REITs over the past week. So in terms of what to keep a lookout for this week, for those who are interested in Singapore depository receipts, including PTTEP, which I spoke about earlier, there's an SGX Academy webinar happening tomorrow. So there's an opportunity for you to understand more about these Thai blue chip names. We have the SIAS webinar coming up this week on 13th of September. This is a members only event. So if you have any questions, do come join us and have us help you with the questions you might have. Apart from that, happening on 30th of September, the US Consumer Price Index data, that is definitely going to be very closely watched to give us a sense as to whether inflation is moderating and that whether we'll see the scope for the Fed to actually keep the interest rates at current level or to raise it further. Last but not least, a lot of investors are very interested in the Singapore T-bill. There's an upcoming auction this week on the 14th of September. So that is another data point to be looking out very closely for. So with that, I'll hand over to Sunny to help us understand what are some of the technical indicator trends and how do we interpret them.
Okay. Thanks, Gerald, for the very detailed sharing on what happened in the local market and, of course, on the broader market as well, and especially what to look out for in the coming weeks. So I'll touch on the technical updates for all the major indices. I'll start on the US side. We had a short week last week, and as Gerald mentioned earlier, for the whole of last week, the 4 trading days, all 3 major US indices actually closed in the red. And for the S&P 500 and the Nasdaq Composite Index, it's the first time in 3 weeks that both of these index closed in the red. So let's start with the Dow Jones Index first. On Friday, it was up 75 points or about 0.22% to close at 34,576. We can see that on the close of Friday, the candle actually managed to close below the 20 days moving average or the Bollinger Band basis. So this signals to us that this is the first sign that there might be weakness in the Dow Jones Index right now because it is trending below the 20 days moving average, and it seems to be a resistance level for now, at least on the short term that we are looking at. And if you can see, if you're looking on the support side, we have a triple top earlier in this year. This is a resistance level which could have a change in polarity. However, I think a stronger or a firmer support would likely come in over this period over here, which is the June period, where you may see a sort of a mini double bottom support coming in. And this level around the 33,700 levels more or less coincide with the 200 days moving average at 34,200. So this is a point where there could be a lot of support coming in for the Dow Jones Index. But this point here is still pretty far away from the current reading that we have, 34,500. So we may be looking at a pullback around a 500 point kind of a drop. And that will bring us to the 34,000 handle before we even look at the double support here at 33,700. or the 200 days MA around the 34,200 level. On the indicators wise, MACD is still negative, although the negative momentum that we see in the past 1 or 2 weeks may have subsided. However, as you can see, the projection from the MACD line and the signal line seems to be going sideways, thereby telling us that probably Dow Jones Index is now very directionless, looking for some kind of catalyst. And as it is still below the zero baseline and still negative, there's still a slight negative momentum in the Dow Jones Index, I see. So for the RSI, it more or less echo what the MACD is saying. It is still below the 50-point neutral mark. The latest reading on Friday we have is about 47.12. The 3 points below the neutral mark. So it's a bit neutral or slightly negative on the momentum side according to the RSI. So with both the MACD and the RSI confirming each other that the short-term momentum at least is likely to be weak and the candlestick is still below the short-term moving average of 20 days, I think it would be more conservative to look at the Dow Jones Index once it comes closer to the 200 days moving average around the 34,200 level or the 34,000 handle before you would want to jump back in to see whether Dow Jones Index can ride back on the uptrend again for the data that's coming up in the next few weeks towards the 20th September rate announcement. Okay, so next we have the S&P 500. So S&P 500, like I said earlier, is the first week in the past 3 that it has closed negative. So it has been on a strong mini uptrend for the past 2 or 3 weeks or so. But last week we see that this is a negative close for the week. And the S&P 500 seems to be using the 20-day moving average or the black color line that you see here, which is also the Bollinger Band basis, as a kind of support for now. So we are right now right smack in the middle, very close to the 20-day moving average. So it's not telling us anything. But however, the trajectory of all the other moving averages are still trending upwards. So that's a positive sign. So probably it's just a temporary pullback or a correction. Okay, so on the MACD, we can see that past 1 week we managed to breach above the zero baseline, and we saw a few positive MACD histogram above that zero baseline. However, that positive momentum that we saw is starting to subside, and you can see that the MACD line is converging towards the signal line, and that means that we may even have a crossover happen. And if a crossover of the MACD line over the signal line towards the downside, that means that downside momentum might accelerate. So that is something that we are watching carefully. So S&P 500 actually broke below this short-term uptrend line connecting the low of March and May this year. So now this uptrend is, I would say, invalidated for now. It may be starting to look for a stronger footing, which probably would maybe come in around this level over here. The first support that I see, which is the low on 26th of June, that is around the 4,300 point level. And that is also the 50 days EMA level at 4,350 points. So that is the first support that I'm looking at. If we manage to get a jump here, and then it coincides with somewhere around this level, probably this level may become a short-term mini triple bottom kind of formation, which could provide some support to the S&P 500. But nonetheless, it has broken below this short-term uptrend line, so it might be going into a range-bound kind of condition until we have a firmer or a clearer picture of how the US economic situation or even the rate hikes is going to happen or not in November or even later this year. On the RSI, we see that the RSI is reading at 49.29, so just 1 point below the 50-point neutral mark. So the RSI is telling us either the S&P 500 is undecided for now or that the momentum is very neutral. So not much kind of a direction. We are resting on the 20-day moving average along with this double top, and then we have some support coming in on the 50 days moving average. And that is also the bottom in June period as well as August period as well. If you are looking for a firmer support, then definitely the 200 days MA, which is around the 4,200 point level, would be the next support that you are looking at, which coincides with the triple top that you see earlier this year. Okay, next let's move to the Nasdaq Composite Index. So Nasdaq Composite Index, similar to the S&P 500, first losing week in 3, broke below the short-term uptrend line connecting the low of March and May this year. So probably the uptrend is invalidated and it may be going into a sort of a range-bound or sideways direction going forward in the near term. So first support we are looking at, very obvious, will be the low here in August, somewhere around the 18th of August. And that level is around the 13,180 points. If I round it out, it's around the 13,200 points level. And if you look at this level, we also have the yellow line or the amber line, which is the 50 days EMA level. Now it's around the 13,300 level. So this is the first support that we are looking at for the Nasdaq Composite Index if it will come down the gain. And of course, on a firmer footing, the 200 days moving average now coincide with the longer term uptrend line connecting the low in December as well as March of this year. That is around the 12,800 points level. So MACD is telling us that the rise that we see in the past 3 weeks is more or less coming to an end. The momentum is actually subsiding according to the MACD histogram. The MACD line is also looking to converge to the signal lines, and if a crossover happens, it could signal a change in direction, and hence it might go down further to push lower below the 50 days EMA line towards the 200 days EMA line for a support. The RSI is now reading at 48.65. It's a neutral to a slightly negative kind of a reading or a weak momentum kind of reading. So I think the pullback on the S&P 500 and the Nasdaq Composite Index is likely to extend into this week. And then, of course, the first support we are looking at 50 days EMA, 13,200 points. That is something everyone is looking out for. Okay, next let's move to the Asia side, the Hang Seng Index. We can see that today the Hang Seng Index is down about 1.26%, and then we also have a low somewhere around here, somewhere on the 21st of August. So let me just put that line in. Previously, we have a double bottom here, and it seems that this double bottom no longer seems to be able to provide the support for the Hang Seng Index. So now we have a gap down today, which is not a very good kind of signal. And if you look at the MACD line, and the signal line or the MACD indicator, it is still below the zero baseline. And what making things worse is that the recent rebound that we see on the from the middle of August to what we see in early part of September seems to be subsiding at a very quick pace. And now we see that the MACD could likely go negative in the next few days, and that means that the downtrend may likely continue. So if the crossover happens on the MACD line below the signal line, that could mean that it can be another leg down for the Hang Seng Index. And the current reading that we have on the RSI is 40, so it's between the 50 neutral mark and the 30-point oversold mark. So it's a sort of a negative kind of reading to me. And if this is the trajectory that we are looking at, probably we will need to test the 30 days oversold trigger to get a rebound, which is similar to what we see over here on the 18th or the 21st of August before a rebound starts to come in. So Hang Seng Index looking negative on the short term, and we are looking at the RSI towards the 30-point mark for an oversold signal for a possible rebound to happen. Lastly, let's talk about the STI index. So last week we talked that the STI index may form a head and shoulder kind of formation, and this may be a strong kind of a bearish kind of chart formation. However, the right shoulder that you can see over here have not really started to form. So I'm not sure whether today the index is most likely flat or down about 3 points right now. So I don't know if the right shoulder is starting to form. If the right shoulder is going to form, that means STI is going to shoot back up a little bit towards the 3,250 or 70 points level. That would form the right shoulder. However, that formation is not validated yet. We don't have the right shoulder coming out. So I think that I'll just keep a lookout for that. So on the STI index, we have a longer term uptrend as well, connecting the low of October and March. And the near term firmer support will come in when connecting the March low as well as the July low and even on the August low. So we have a sort of a triple bottom kind of formation and forming a slight positive gradient of an uptrend line over here. However, the STI index looks to me now that it is trending along where the 20 days moving average is going. So that trajectory, and if I'm going to zoom in, is going to be sloping downwards in a very steep kind of angle. So if the STI is looking at following this kind of direction, it will likely see more downside in the coming few days or the next 2 or 3 weeks. The MACD indicator, as usual, similar to what happened in Hong Kong, is now also very close to going into the negative kind of a reading. The MACD histogram, the positive that we see in the past 1 or 2 weeks, is already subsiding or negating at a very steep pace. And we are looking at the MACD histogram probably going negative very soon, which means that the MACD line will cross below the signal line, thereby putting more downside pressure or indicating more negative momentum on the STI index. The RSI managed to breach somewhere slightly above the 50-point neutral mark somewhere around the beginning of September, and we thought that that is a good sign, and that trajectory might actually push up slightly further, at least to the 3,200 or 3,250 or 3,270 points level. However, that now seems not to be happening because the RSI has already trended down lower. And you can see now the latest reading at 43.30 is actually about 7 points lower than the 50-point neutral mark. So it is still closer to the neutral mark than the oversold signal of 30 points. So I think STI now is should continue the gentle slide downwards until it finds a firmer footing along this slight gradient of an uptrend line connecting the March, June, July and August low, and that could be a stronger support for the STI index should a bounce is ready to happen, and that could coincide with the RSI going into the 30-point oversold mark when we see that happen. So that is all I have for this week technical analysis update on the major indices in the world. Anything else to add, Gerald?
No, thanks a lot for all the very detailed technical analysis. I think given that a lot of the markets seem to be just waiting for the direction next as to where they are going to be moving towards, it goes back to what we shared earlier about having to keep a very close lookout for the consumer price index data this week, what Fed officials will say at the meeting next week, to give us more direction as to where the market is headed. So continue to keep a lookout for our weekly market update, where we'll continue to keep you updated around what is happening around these two indicators that we are watching very closely for.
Okay, I think Gerald very well sums this up for what we have covered today. So I think we will see the members on Wednesday. Gerald will be joining us as well. So if there is nothing else to add on, we will end this week's video here. I hope everyone have a good trading week ahead.
Thank you.